Hello, this is Dale. I have more than 35 years of experience as a professional stock investor and hedge fund manager. During my journey, I've gained a lot of insight on how to become successful in the markets. Today's lesson is entitled Credit Spreads Demystified. Credit spreads are one of the best trading strategies that I use. What I want to do is to explain the difference between a bear call and a bull put, how you set them up, what you look for, and how you can profit from them. The advantages of credit spreads there's many advantages. First thing is you can get great returns when coupled with a probabilistic approach to price action. In other words, what we're going to look for is a very high probability trade, and this will allow us to get great returns. This strategy can yield monthly income on a consistent basis. Now, that doesn't mean we're going to have all winners. Any strategy, any system will have losers, if not losing strings, and you must learn how to react to those, accept them, and keep trading and executing according to the rules that you've set up. There will be some months when you don't have winners, but over the long run, what we're going to look for is an equity curve that has very little drawdown. Therefore, it has consistent monthly yields. Like I said earlier, this is a high probability of success. Most of the credit spreads we're going to put on have a delta of about 0.1. 0.1 delta means that there's a 95% chance that option will expire worthless, and those are the options that we are selling. So when it expires worthless, that means we're taking the maximum credit from there. When we sell premium, time is in our favor. With credit spreads, you don't have to constantly watch the market. You don't have to chart hawk. And that brings about a little bit more freedom as far as doing other things. You don't have to constantly be watching that computer. It's a low anxiety trade. The way we're going to set this up is you're not going to be affected on day-to-day trading unless you have a big move one way or another. And with the credit spread, what we're doing is we're selling, but we never sell naked. We always are going to buy an option further out of the money, and that is for protection. The other protection we have is if you set up rules whereby if it gets to a certain point you're going to get out, that's going to protect you against catastrophic losses also. Once again, we want to look at the option decay. This is known as theta decay, and where the price of the option as it gets closer to expiration decays exponentially, especially in the last 30 days. You can see that it comes down at a pretty steady slope, but it gets that last 30 days, it just drops off exponentially. That's the time period when it's best to put on a credit spread and follow it. Think of a credit spread as simply selling one and buying one. What you're going to do is you're going to make money on the one you sell, called the short strike. But the potential loss can be unlimited. When we put on a credit spread, we're going to not only sell one, and that would be called selling naked, we're going to go ahead and buy one called a long strike. This is the one that makes you money when it passes the strike price. Your maximum loss, of which you should never take, is only going to be the difference between the two strike prices. Like I said earlier, you should set up rules so that the maximum loss is not even that difference in the strike price, but that's your ultimate. If there is a catastrophic drop or a very quick rise, you are protected against those big moves by having a credit spread put on. So let's go through the construction. First, let's look at a bull put. What I've got here is an option chain. This is for the RUT. And what we're looking at is the option chain for 17 November. And we've got the calls on the left and the puts on the right. I'm looking for a bull put. And by the way, a bull put, what we're doing is we're selling a put and buying one further out of the money. And it's called a bull put because it is a bullish strategy. Okay, so let's take a look. If we go out about 24 days from expiration, what we're going to do is we're going to sell the 14.35 strike price, and for that we're going to capture $4.95 worth of credit. What we're also going to do at the same time is go ahead and buy the 14.30. The 14.30 is further out of the money, and it's going to cost us $4.50. So the difference between these two credits is what we will actually receive, or 45 cents. Now, a lot of people look at this and say, well, why don't I just sell this naked and capture all the $4.95? The only problem with that is, one, you need a tremendous portfolio size for the market managers to allow you to do that. Second thing is they're going to require a lot of margin for you to set up that trade. Whereas if you do a credit spread where you have one where you've limited your loss by buying one further out of the money, your amount of margin required by the brokerage is going to be a lot less. So the return on margin actually is greater by setting up a credit spread with protection versus selling naked. Also, I'd like you to notice at this point in time we're selling the 14.35, and you can see that right here we have a delta of about 0.15. Usually what I do is kind of look between the delta of 0.1 and 0.2 and kind of zero in on whether there's support and resistance, and does it make sense to set up the credit spread at that point. Remember that the delta of 0.15 means that there is 85% probability that this one will expire worthless. So we have 85% chance that it will. However, by buying one further out of the money, we are protecting ourselves even against that additional potential loss. Continuing on, graphically what we're looking at is, let's say that the price line was right around here. What we do is we go out of the money and we sell one, and in this case the price of price line was about 1920. So what we're doing is we are selling. We're coming down here all the way down to 810, or 110 points below where we're at, and selling that 810. And for that we're getting $20.78. But what we're doing is we're buying one further out of the money at 1800, and that will cost us $18.71, but we get a net credit then of $2.07. Now, the interesting part about that is we are way out of the money. We are way out of the money. Okay? And this had about, I think it was about 20 days, 25 days till expiration. So the other nice thing about the credit spreads, in this case it's a bull put, if it goes up, we can profit. If it goes sideways, we can profit. As long as it stays above where the option we sold by expiration, we can profit 100%. So that's the beauty of a credit spread. You don't necessarily need to know the direction. Yes, it's better. I mean, it is a bullish strategy. It's better if you have a feeling that it is going to go up. But if the market doesn't go exactly the way you had analyzed it, you're still protected and you still have a potential to profit handsomely with a credit spread. This is the profit zone, like I call it. Here is the RUT, and it was sitting at about 14, let's call it 1500. And we set up a bull put where we came all the way down here and we sold. We sold right around the 1435 and bought the 1430 for protection. Like I said, you can profit if it goes up. You can profit if it goes sideways. You can profit if it goes down but doesn't go below this point. This is a very large profit zone. Yes, there are times when it's going to come down like this, when our analysis completely backfires. At that point in time, you need to have rules in place. One of the rules I like to use is when it makes a measured move to the downside or a lower low. Other people use support and resistance lines. Other people use a percentage of loss, and that is their exit. And you always want to have an exit strategy in mind before you enter the trade. This is called the risk profile, and this is how you manage the credit spread. The green line is what it would be when it expires. You can see that this is the max profit you can make. And then your loss is truncated by this wing down here, and that's the option that you bought. In this case, we have a bull put, so this is the put that you bought. The combination of the one that you sold and the one that you bought gives you this amount of credit. What you want to do is every day just take a look at this risk profile, and the purple or blue line here shows you what its value is today. And you'll notice that it's a curved line versus the straight lines for the bull put at expiration. It will show you a price where it is that day and the amount of money that you're actually making. As long as you stay to the right of the break-even point, what you want to do on your bull put is just let her go. Let it work. Okay? When it goes to the left and you begin losing and you're out of the profit zone, that's when you want to watch closely and make sure you don't allow the loss to get out of hand. So the three things that you need to really understand before you place a credit spread is the option chain, how far out you're going to set up your credit spread. Are you going to look around a delta of 0.1? Are you going to look around 0.2? It really all depends on your risk tolerance. Then you're going to manage it using the risk profile that we're looking at right now. And you always want to put the channel on a chart so that you can see how it's reacting. I always put the profit zone on my chart too, so that I've got a visual look, not only in the risk profile, but I've got a visual look on my chart as far as where I am in that profit zone. Okay, let's look at a bear call. The bear call is just the opposite of the bull put. What we're doing is we are selling a call and buying one further out of the money. It is a bearish strategy, a bearish strategy. Here what we're doing is we are selling the 1560 call, and we are buying back the 1565 call. And what we've got then is the credit is about 50 cents between the difference between those two. On this side, what I looked at was support and resistance, and decided that the delta, I wanted to go a little bit further out of the money and have a little bit more of a conservative trade on the bear call side. Well, when you go with a little bit more conservative trade, of course it's always a risk-reward balance, and you're going to capture less credit, less reward for less risk. The other thing a lot of people do is this is the implied volatility for this RUT over 24 days. And basically what it's saying is it's got a probability, one standard deviation, of moving plus or minus 45 points. What you can do is you can take the current price, and that's about 1500. And in this case, you would add 45 points to take it 1545. I like to be more conservative and go a little bit further out of the money to put on my credit spread. So I'm way out based on the probability that it will expire worthless. Okay, notice in this particular example, this is an Amazon example, where the price was down around here. What we did is we came up here and we're selling the call and then buying one further out for protection. We sold the price of Amazon was 1010, and that was right about here. Okay. So what we did is we sold the 1050 and bought the 1060. And for that we got a net credit of $1.80. Now, let's take a look at what happened. With a credit spread, remember I said if it goes, in this case, it's a bear call, it's a bearish strategy. The first day it worked well for us, but then it started to come back up against what we were thinking. Then it went back down, that's good, but then it came up a lot, then it went sideways, and then it dropped for 2 days in a row. And at this point in time, it was only slightly below where we set the credit spread up at, and we profited very handsomely. I usually don't wait to take all the credit. If I can get most of the credit before expiration, I will take that and get out. Again, here's the profit zone for a bear call. And what we were at that point is, if you can recall the Amazon chart, it went down and then it came up, and then it went down again, then it came up, and then it came down again. We were in the profit zone, only time was in our favor. We were right around here, and that's how we were very close to getting the maximum profit. When we're very close to getting the maximum profit, if we're within 75 or 80% of taking the max profit, I will go ahead and take that. Especially if most of these you want to set up about a month before expiration. If you're getting about max profit and you're only 15 days in, why hold the credit spread and be exposed to risk for another 15 days to just capture a very small additional point of credit? Once again, this is how we manage it. If it's to the, in this case, if it's to the left of the break-even point, we just let it go. If it's to the right, that's when we start looking at what should we do. Are we getting to the area of resistance? Do we have a higher high happening? Should we be getting that? Now notice it's the combination of this risk profile and the profit zone picture that I put on a chart that really helps you to determine whether or not you should stay in there or whether you should exit. Now the last thing I want to talk about on credit spreads is you can set up credit spreads on any stock. But the cheaper, the less expensive the stock, the less credit you will get. Therefore, I trade the big boys. I trade Amazon, Google, Priceline, the Russell 2000 indices, and the S&P 500 indices. Because what I'm doing here on this chart is I set up a bull put spread just 43 days from expiration with a delta of 0.1 with a 10-point spread. And this is the credit spreads that I got for the big boys, over $1 in most cases. Compare that to common stocks that are trading right around the $50 to $100 region, where you're only getting about a quarter on the credit spread. On the Verizon here, you're only getting 19 cents. Now the problem with this is, yes, you can set up a credit spread here, but you might have slippage. In other words, you might not get the full 19 cents when you set up your trade. I always put the price in at the midpoint, halfway between the bid and the ask. Sometimes you'll get filled. The floor traders will not be able to fill you at that 19 cents, so you'll have what's called slippage. So say it goes, they fill you at 17 cents. Okay? Then you're going to have some commission associated with that. Let's say that drops it down to 15 cents. Okay? That's a big chunk. That's about 25% of your potential profit here that's gone. That does not occur up here with the big boys. Let's say this slips down to 98, and then you pay commissions on that. It drops down to 95. You only have a 5% possible drop if you don't get a good fill. You say, well, why don't I just go ahead and buy multiples of the small companies? In other words, 4 times as many. See, when you buy 4 times as many of those small companies, you're going to have 4 times the commission. And that's why I stay with what I call the big boys. Amazon, Google, Priceline, and the Russell 2000 indice, and the Standard & Poor's 500 indice. So I hope I demystified credit spreads for you. And the thing to remember is to make sure that you go out about a delta that you're comfortable with as far as your risk tolerance. You want to make sure that you determine what the best strike price difference is. For the big boys, I use 10 points. For some of the smaller ones, that weekly options and so forth, I'll go with only 5 points. And then the last thing is, how far out are you going to sell those? Once you have that set up, you want to manage it by the risk profile, the combination of the risk profile and the profit zone, to determine whether you want to stay in or get out. Happy trading, everyone. Bye-bye now.